At 9:29, two trading EAs are watching the same chart. Same price, same candles, same apparent breakout. One buys immediately, the other does nothing. 10 minutes later, the first trade is stopped out. The second EA never loses a dollar. So which one was using artificial intelligence? You cannot answer that from a single decision. And that is exactly where most conversations about price action AI go wrong. The scene is hypothetical, but the problem is real. People often imagine an intelligent trading robot as a machine that can look at a chart and somehow understand what the market is thinking. It sees a wick, senses fear, recognizes institutional buying, and predicts the next move. That sounds impressive. It is also a dangerous way to describe what software actually does. An EA does not see intention, it receives data. Price, time, volume when available, spread, volatility, maybe economic calendar data if someone has connected it. Then it applies rules or a trained model to that information. If news data was never included, the EA does not know a central bank announcement is approaching. If spread is not part of the logic, it does not know execution has suddenly become expensive. And if it was trained only on calm markets, it may treat a violent price spike as a perfectly normal setup. The real question is not whether the robot looks intelligent. It is whether the robot knows when the same pattern means something different. Return to those two EAs. Both detect a break above a recent high. The first one has a simple instruction. If price crosses the level, buy. It follows that instruction perfectly. But the second system examines the surrounding conditions. Has price been compressing beneath the level, or did one oversized candle appear from nowhere? Did the candle close above the range or merely stab through it? Is the spread normal? Is this an active session or a thin period when price can jump without meaningful follow-through? The breakout is identical on the surface, the context is not. That difference is the foundation of adaptive automation, not prediction, selection. The system is trying to separate situations that deserve risk from situations that only resemble them. Now move the chart forward. The market stops ranging and begins to trend. Price pushes higher, pauses, pulls back, and continues. A rigid EA may keep selling every overextended candle because that behavior worked during the earlier range. An adaptive system should notice that the environment has changed. Maybe it reduces counter-trend trades. Maybe it requires stronger confirmation. Maybe it stops trading that setup completely. The exact response depends on the strategy, but something important must change. If the market changes and the robot behaves exactly as before, the word adaptive is probably doing more work than the algorithm. Then comes the hardest test. Nothing is broken, the software is online, the setup is valid according to the model, but the best action may still be no trade. This is where smarter EA trading often becomes less exciting, not more. Good automation does not need to turn every observation into a position. It can wait when confidence is weak. It can reduce exposure when conditions become unstable. And it can accept that missing a move is sometimes cheaper than forcing a trade into an environment the model was never built to handle. None of this proves that adding more filters creates a better robot. Too many conditions can produce a beautiful backtest and a useless live system. If developers keep adjusting rules until every historical loss disappears, they may not be teaching the EA to adapt. They may be teaching it to memorize the past. That is overfitting, and it can hide behind very sophisticated language. A credible price action AI system has to survive questions that marketing rarely shows. What happens on data it never saw during development? Does the logic remain stable when spreads widen, entries slip, or execution is delayed? Does performance depend on one market phase, one instrument, or a tiny group of exceptional trades? And when live behavior differs from the backtest, can anyone explain why? This is why a polished equity curve is not the end of the investigation. It is the beginning. The useful evidence comes from out-of-sample testing, walk-forward evaluation, realistic trading costs, stress tests, and forward observation under conditions the developer cannot edit afterward. Even then, there is no guarantee of future profit. There is only better evidence that the system is responding to market structure instead of exploiting accidents in old data. Price action can be a powerful input because it keeps attention on what price is actually doing. Artificial intelligence can help classify patterns, score conditions, or adjust decisions when the environment changes. But neither one gives a robot human judgment by magic. The intelligence comes from the full design, the data it can observe, the situations it was trained or programmed to recognize, the actions it is allowed to take, and the risk it refuses to take. So go back to 929. The EA that stayed out may have made the smarter decision, or it may simply have been lucky. One trade cannot tell you. A sales page cannot tell you. Only the system's behavior across changing conditions can begin to answer the question. If you are evaluating or building automated strategies and want more practical breakdowns like this, you can join our community through the link in the description. A smart trading robot is not the one that always finds a trade. It is the one that knows how little it actually knows.